This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The cushion of safety seems more like a cheap motel mattress, razor thin and getting increasingly uncomfortable. With valuations rich and AI-related stocks considered infallible, it won't take much for an uptick in volatility. Up next, let's make sense of this backdrop and the confusing cocktail of headwinds and tailwinds. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Happy to be with you despite the wording of the title of this week's podcast, Bubble, Bubble, Toil, and Trouble, my bastardization of the famous line from Macbeth. I'm not sure we're in a bubble, nor do I really know what an investment bubble is. But I do know that when an investment narrative, in this case, the AI trade, right? Anything AI related, when it's considered almost infallible like it is now, at the very least, our antennae should be up. To wit, we had a very interesting week in the market marked by significant rotation out of AI names into other pockets of the market. In fact, according to Duality Research, since 1996, only 2 other days have seen stronger S&P breadth paired with a bigger loss. What does that mean? On Tuesday, we saw a lot more stocks go up than down, right? The S&P 500 breadth was strong. But because some of the big tech names, the AI names at the top of the S&P, got crushed, the overall market had a bad day. It was really interesting divergence, and it shows you just how quickly things can change and how violently they can change when, one, the market bets get stacked in one direction, like I said, the infallibility of the AI trade, and 2, when valuations get stretched. Just leaves you with very little margin for error. Let's take a look. Something that Goldman Sachs said earlier this year that I referenced on a previous podcast, and a lot of that has come down to the fact of where valuations are. Essentially, Vanguard is saying, when they look out at the next 10 years and where starting valuations are, that U.S. equities probably will return in the 3 to 5% range with some, margin of variance. 3 to 5%. Growth stocks even less. Interestingly, they have value stocks more like 5 to 8%. But U.S. stocks in aggregate, 3 to 5%. They have bonds returning roughly the same, maybe even better. Because remember, there is a very strong statistical correlation between starting yields on bonds and future 7 to 10-year returns, meaning if bonds are yielding roughly 4.5%, that's about what you should expect in terms of return over the next 70 years from bonds. At least that's what history shows. So you can see where Vanguard's coming from. If you can get almost the same, if not better, return from bonds with theoretically less volatility and less credit risk, why not be more weighted in that direction? So listen, I'm not saying I agree with that, but I think it's worth noting, okay? Particularly if you found your portfolio too skewed in the direction of stocks, or maybe you've given up on bonds because they haven't returned as well as stocks over the past 5 years. Be careful about recency bias. Be careful about looking in the rearview mirror. Think about conservative estimates of what asset classes might return going forward. That's the only thing that counts. So let's get back to the fact that performance has been concentrated in a small number of names. And there's a reason for it, right? As it was pointed out by Ryan Dietrich over at Chart Reports. He said the other day, the Magnificent Seven, you've heard that term, the Magnificent Seven aren't just driving the bus. They built it, filled it with cash, and left the S&P 493, the other 493 stocks in the S&P, chasing fumes, end quote. Think about that for a second. That's a pretty powerful statement, but it's true, right? And keep in mind the dominance of these top, 7 names in the S&P 500, the Magnificent Seven. It isn't just hype. It's basic math. Remember, the stock market at its core is a long-term weighing machine, and what it weighs most is earnings. If you look at the earnings growth of those 7 names versus the rest of the market, it's pretty unbelievable. So last year, This is according to Sandbox Financial Partners. Last year, the Mag 7 had 40% earnings growth year over year. Rest of the S&P, 4%. Year before, 31% earnings growth, minus 4% for the rest of the S&P. This year, 20% for the Mag 7, 7%, give or take, for the rest of the S&P. So the outperformance, the dominance of the Mag 7 has been backed up by the dominance of their earnings contribution. And over the last decade, the market cap of those 7 stocks has grown by nearly 800%. That's roughly 150% for the rest of the benchmark. So, there's a reason why those names are dominant, but the reality is those names are dominant. I mean, just NVIDIA, Microsoft, and Apple alone, by my math, make up about 21% of the S&P. 21% of the S&P in 3 stocks. That's the highest weighting for any 3 stocks in the index ever. Largest 10 in the S&P, almost 40% of the S&P 500. I could go on. You get what I'm saying here. And it's probably even more concentrated than that if you really think about it, because a lot of this is incestuous, right? Like Meta, Microsoft, Alphabet, Amazon, they're going to spend, $400 billion on AI this year, or give or take. But that capital expenditure translates to sales from the other tech guys, NVIDIA, Broadcom. So these guys are all selling to each other, right? It's not like, Microsoft is buying $100 billion worth of goods from the 300th largest company in the S&P. No, they're buying it from another top 10 weight in the S&P. So obviously, in a virtuous cycle, when AI spending is growing through the roof, that's a good thing. But if there are any sort of hiccups in the, return on investment for AI, it can have a multiplier effect. And we saw that, right, earlier this year. Wasn't that long ago. March, April, NVIDIA went down 40% because there was a Chinese product that promised to be able to deliver as good performance in their chips at much less cost. Okay, some of those fears have dissipated since then, but still, those fears are out there. So, again, I'm not making a call that these companies are problematic. I'm not making that call at all. It's just very important for you to understand how concentrated the S&P is, and not just in the market, in the economy. There's been a widely circulated statistic recently. I'm not sure where it came from originally, I'll be honest, but it's been widely circulated, and I think it's accurate, that those big tech firms that I just mentioned are contributing essentially the same amount of GDP growth this year as the entire U.S. consumer base. Entire U.S. consumer base. Think about that. The consumer, you and me, is 70% of the U.S. economy, 70% of GDP. So AI essentially is contributing more than all of us going to the mall, buying airplane tickets, going to the restaurants combined. And, I mentioned market cap weighting, I mentioned sales. Also think about it in terms of performance. According to Seven's report, 5 stocks, this is as of last Friday's close, so as of a week ago, 5 stocks, NVIDIA, Microsoft, Meta, Broadcom, and Palantir, have accounted for roughly 6 percentage points of the S&P 500's 10% plus year-to-date return. 60%. Information and tech and communication services combined, almost 2/3 of the rally this year. So, think about that. So if you have a portfolio of, that does not involve technology or some of those AI-related names, there's a good chance you've had no return this year or very little return. Okay? And the other kind of key point I want to make here, because I said it a minute ago, I'll say it again. I'm not making a judgment on these names. This is not a research call. It's more of an observation call. Know what you own. I get at least a client a week, probably more, saying, I just want to be conservative and just own the S&P 500. There is nothing conservative about the S&P 500 when it's this concentrated. Know that you are making a concentrated bet on a handful of stocks in 1 or 2 industries, because the second or third largest company in the S&P, I don't have the exact stats in front of me, but they might contribute more to the performance of the S&P than the bottom 100, 150, 200 stocks combined. So doesn't mean you should own the S&P, but just know what you own. And also know that, and I said this on the podcast 2 weeks ago, that if you have a portfolio spread across multiple exchange-traded funds, mutual funds, managers, make sure you understand the top 10, 15 holdings of those funds. There's a good chance they all own the same stuff. So you might think you're diversified, right? Because you have 10 funds or 15 funds. But if they're U.S.-oriented, S&P-oriented, large-cap growth-oriented, chances are a lot of those holdings look the same. There's a lot of overlap, which is great when everything's going well. When the S&P is doing great and tech stocks are leading, it's worked out for you fine so far this year. But if the worm turns like it did in April, it can turn badly. Just make sure you know that. Meanwhile, by the way, defensive stocks, for the most part, there are obviously individual stock exceptions, have been left for dead. And Strategas noted this week that the parallels of performance from the dot-com bubble relative to today, in their words, are striking. The decline in the combined sector weightings from the 2022 lows through today of healthcare and consumer staples and utilities, the three more economically defensive sectors, is roughly 9 percentage points in index weighting. So in other words, those three sectors combined contribute 9 percentage points less to the S&P 500 market cap than they did in the fall of 22. That's almost exactly what we saw during the dot-com bubble. But I bring this up because this week, those were three of the best performing sectors. What has happened is their earnings weight of those companies, in other words, the amount of earnings they contribute to the S&P, is now much greater than their market weight in the S&P. That's often a sign of pretty significant undervaluation. Whenever there's a disconnect between how much the earnings contribute versus the weighting. Okay, what I'm getting at is if you have abandoned some of these value type, not necessarily value specifically, but more defensive type sectors because, to sort of chase the AI trade, hey, you've done well. God bless you. But just remember that portfolio balance tends to be important over longer periods of time. And it would not surprise me at all. We still have a lot of tech and communication services oriented and AI related companies in our client portfolios, but wouldn't surprise me at all if, like we saw the last few days, if we start to see better performance on a relative basis from some of these other areas. Keep that in mind. I took Latin in high school for 4 years. I don't know why, but I did. Aurea mediocritas. I think that's Horace. Preserve the golden mean. Keeping some balance means something. By the way, I read a Bank of America survey, just kind of on a related note, that this is as of 2 weeks ago. 91% of survey respondents thought that stocks were overvalued. However, they were, on balance, more bullish than it had been all year. So here you have a lot of respondents saying, yeah, we know the market's pricey, but you know what? Market keeps going up, so I'm going to stay in. Be careful about that too. Be careful about, FOMO, fear of missing out. This week, for example, 8 out of the 11 sectors in the S&P are actually rallied, yet the S&P 500 was negative. And remember what I keep saying, and I've said it for years, I'll continue to say, valuations are a poor timing tool, right? Nobody rings a bell and tells you when things are going to go the other way. However, valuations do have something to say about long-term risk and reward. So when something gets way overloved and something else gets way underloved, those have a way of reconciling over periods of time. Just a few other things I'll mention about the market. I'll leave the topic of valuation for now. Just some kind of seasonal things. Remember, I said a couple weeks ago that this is the weakest time of the year for stocks in aggregate going back 100 years, August through October. So some of this is just seasonally we should expect some volatility and maybe a bit of a pause after a 34% rally off the lows. There's also an election year cycle that I've referenced before. According to Carson Investment Research, the average post-election year peaks in early August and tends to bottom in early to mid-October. All right, so again, from a typical election cycle, this is often a period where you see some selling. But I will tell you that, as I've said before, I think a pause, maybe even a correction, I don't think it's something to fear. This is just my opinion. Certainly not making predictions, because a lot of what we've seen bodes or augurs for future gains. So, this week, the S&P 500, according to FactSet, moved below its 20-day moving average, which is a measure of short-term momentum, for the first time in about 68, 69 trading days. Carson found 8 other times when the index was above the 20-day moving average for this long. And these long streaks, even though they've ended, historically, the market was higher 7 out of 8 times over the ensuing year. And I've quoted similar data to you that when we get these types of momentum surges off of important bottoms, yes, you might have a pause, but generally speaking, obviously history is no guarantee of future performance, but generally speaking, it bodes for higher markets 12 months out. By the way, you might be asking about, and I'm not going to talk too much about the Fed today, but there's about an 85% chance, if you believe the Fed futures markets, that the Fed will look to cut in September. And you might wonder, well, what's the precedent for cuts at all-time highs? Well, Carson also notes that when you see Fed cuts near all-time highs, and this is going back to 1976, stocks were higher a year later 20 out of 20 times. 100% track record of being higher. By the way, over that same period of time since 1976, the market is also a higher 100% of the time, following when you get a cut after a 6-month pause since the last cut. So I'm not going to, belabor these points, but again, some of what we are seeing is, in my mind, more of a reason to expect some short-term difficulty, not necessarily longer-term difficulty. Obviously, if the economic data really deteriorates in a way that is beyond what we're expecting, we'll, of course, have to reevaluate that. But just keep some perspective. Keep some perspective if the market gets a little dicey here over the next 30 to 60, maybe 90 days. All right. Let me transition a little bit. I just have a few thoughts about the economy. I've kept a quote in my desk for a long time from Donald Rumsfeld. You remember him, right? Quote, "There are known unknowns. That is to say, we know there are some things we do not know, but there are also some unknown unknowns. The ones we don't know, we don't know." Basically what he's saying is that, you can always have black swans, right, which are by definition things that we're not anticipating, that aren't on anybody's radar. Hard to predict those because by definition they're not predictable. But there's some other things in the economy that we don't know with certainty, but everyone is aware of them as risks, right? And some of those risks, because of that, are likely priced in. Maybe some aren't because we don't know the depth and duration of some of these problems, but they are well-known problems. So I just thought I'd bring you up to date on some of those. We all know about inflation. Despite political rhetoric on both sides, inflation is getting worse. It's inarguable. Okay, we saw the core CPI, Consumer Price Index, gains in June and July. Core PPI, Price Producer Index, that was hotter than expected. So clearly, inflation has begun to reaccelerate. Yes, there are some offsets to that, like housing prices and rental prices are down year over year. Gasoline is down year over year. But if you look at core CPI that just looks at goods prices, strips out some of those things, clearly accelerating. I'm less concerned about that because, from a stock market perspective, I'm more concerned about who is bearing the brunt of that. And we've talked a lot about this, right? But I'll continue to talk a lot about it. There was a new Goldman Sachs analysis the other day that finds that so far, U.S. consumers have absorbed only a small portion of the tariffs. basically 22% of the tariffs so far. This is as of, I think, about a week and a half ago. All right. Meanwhile, U.S. businesses have absorbed almost 2/3 of tariffs. But they think that's going to change pretty significantly here going forward because Chinese goods, including cars, were hit with tariffs first before the broader application of the so-called reciprocal tariffs imposed on multiple countries. But by October, Goldman thinks that the U.S. consumers will be on the hook for essentially the exact reverse. It'll be the consumers on the hook for about 2/3 of the tariffs and only about 8% for U.S. companies. So obviously, we'll talk about the consumer in a second, but that is theoretically a better thing for companies, right? Because what have we talked about for 2 years? U.S. profit margins are at an all-time high, and that's really been the main driver of the S&P 500. I mean, we can talk about AI, obviously, as well, but from a operational earnings perspective, it's been the fact that profit margins have been better than anyone anticipated. And we've also talked about how the economy is not the same as the stock market. Corporate America has numerous levers, particularly larger companies with diversified operations have numerous levers that they can pull to control margins. And as mentioned, Goldman Sachs expects corporate profit margins to actually expand in the coming quarters. Not to mention that they get, particularly some of the larger companies, not every company, but because of the big, beautiful bill, the new tax bill, because of the ways that a lot of companies can expense research and other development, Goldman estimates that'll add as much as 10% in free cash flow to the S&P 500 in aggregate. Okay, so this definitely could be a time where corporate earnings outperform the U.S. economy. And by the way, we're just putting the finishing touches on the second quarter earnings reporting season. And what did we see? 10 of 11 sectors, according to FactSet, saw earnings estimates beat by greater than 70%. What I mean by that is more than 70% of companies in 10 of 11 sectors beat earnings. Okay, that's one of the highest hit ratios in a long time. And it's important because, there's been this narrative out there that it's only AI and tech companies doing well. Well, that's not necessarily true. Yes, they have a much bigger weighting in the S&P. I mentioned earlier, much bigger contribution in earnings growth to the S&P. But that doesn't mean that everyone else is doing poorly. And in fact, financials saw the largest gain in this quarter year over year. It wasn't tech, it was financials. But obviously, if inflation is going to get passed through to the consumer has to be able to pay the bill or be willing to pay the bill and go out to the restaurants and buy airline tickets and everything else. We saw that in coming out of COVID. Inflation was 8-9%. We all bitched and moaned, but, investors still and consumers still paid the prices. We didn't see a big drop-off in U.S. retail sales. We know that multiple data points are pointing to a sluggish market, so don't get caught up in the politics of believing the BLS data. Multiple independent, private monitors of the job market are all kind of saying the same thing. We're not seeing a lot of firing, barely any firing actually, but we're seeing almost no hiring. So that's why I use the term sluggish. It's interesting, the Fed just recently, the San Francisco Fed rolled out a new indicator that I'd never heard of, called the Labor Market Stress Index, LMSI. Their conclusion from that index is that recessions are unlikely without 30 or more states seeing rising unemployment. Currently, the unemployment rate is steady in 47 out of 50. So it seems like we're a long ways off from unemployment rolling over. And the reason I mention this is, I've said it 100 times. If we have jobs in this country, we're still spending. So if you want to ignore most of the economic data coming out, and you probably do anyway, just focus on jobs, maybe inflation number 2, because that's going to tell you 90+% of what you need to know about the economy. By the way, we know we're starting to see more and more evidence of, AI taking jobs, right? I mean, you probably read I've read it in several places that this has been the weakest job market for kids coming out of school in something like 35 years. Some of that is Companies aren't hiring because of tariffs, right? So it might pick up in 26, hopefully. But some of it also might be, AI is taking some entry-level jobs. That has to be part of it as well. But the key point I wanted to note, and this is from Sam Coe, a blogger that I follow, is that, he found that 60% of the workers today are employed in occupations that didn't even exist 3 or 4 decades ago. And the follow-up point being that throughout history, technological advances have led to significant and persistent reductions in labor demand. Yet at the same time, employment's still grown steadily because that technology has created other types of jobs that weren't even a thing. We saw that when the cell phone came out, when the internet came out. AI, certainly disruptive in the short term in terms of the labor market, may not be as disruptive over a longer period of time than you think. But again, consumers still in relatively good shape. And as I mentioned with the big beautiful bill, there is some, as Strategas puts it, some sterilization of some of the tariff impact in terms of some of the treatment, particularly for corporations. So, we'll see. We'll see. The last thing I will say from kind of a profit margin and labor statistics standpoint is that Morgan Stanley came out with something this week that I thought was interesting, that they estimate that corporate America in aggregate, I don't know how they measure corporate America. This is their study. But they came out and said that corporate America will save $920 billion annually, $920 billion annually from a full adoption of AI, artificial intelligence. It's a lot of money. Furthermore, they estimated that represents about 40% of the annual compensation expenses within the S&P. Longer term, they didn't specify what longer term means, but longer term, according to Morgan Stanley, this could result in $13 to $16 trillion in market value creation for the companies in the S&P 500. So now, obviously, that could come at the expense of payroll, of our jobs, which is why I made reference to the fact that maybe AI hurts the job market in the short term. Maybe in the long term, other industries are created. But I think from just a purely investment standpoint, that's pretty darn significant. And maybe one of the reasons why some of the valuations that I talked about earlier that are really pricey, maybe some of that will end up being justified, particularly if we do get a bounce back in economic activity next year. So I realize there are a lot of ifs out there, and we'll be monitoring these ifs. But I guess the bottom line is it's very important not to get sucked into just one narrative. You can't look at tariffs in isolation and say, oh, market's going downhill because of that. You've got to look at all the combination, the cocktail of headwinds and tailwinds, because there are tailwinds. And I would also suggest don't get overly caught up in what the market signals here the next month or two, because, again, a pause, even a pullback of some degree would not be a shock at all. All right, up next, I don't have a lot to say on the individual stock front this time around, but I do have a couple things I just want to mention briefly. Back in a minute. The new administration is certainly upturning the status quo, but you don't have to be a disruptor in your own portfolio. It could be wise to keep calm and carry on. Tune in every week as we discuss the latest financial trends and how to filter out the noise distracting you from sound portfolio management. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the WIG Investor Group of Raymond James. Don't have a whole lot to say on the individual stock side today. I'll probably have more in a couple weeks because we're still waiting to hear from a couple of the big chip names, NVIDIA, Broadcom, also Salesforce, which is a Dow Jones component. So there's still some big names left to report. I'll try to give you some updates next time I'm on. Remember, if I'm talking about individual stocks and it's something that you're familiar with, maybe you own in your portfolio. A lot of the names I mentioned, in fact, the names I'm going to mention today, we do own in many of our client portfolios. I also own these names personally, so you should consider that a conflict of interest. I would also note that if you're not a client and you're managing your own money or you're working with a different financial advisor, you really need to do your own homework. Make sure it's right for you. If you are a client, I think you can feel comfortable that we've done our due diligence and feel pretty good that these are appropriate and suitable for your particular situation. We just started nibbling in many of our client portfolios on a company you may not be familiar with called Vistra Corporation, VISTRA, symbol VST on the New York Stock Exchange. They are a leading independent power producer, predominantly electric, although they have a significant nuclear presence. I'm not going to get too much into them today, but that's been a bit of a blind spot, and well, maybe that's not the right term, but we have not really had much in the way of electric exposure. The real story behind Vistra is they have a traditional power business, but they also have a pretty significant tie-in to what's going on with AI. You've probably read about this significant power demand that AI is sort of leading us towards. Data centers require a ton of energy, and there have been estimates out there as much of a doubling in power demand over the course of the next 10 years as a result of this. So Vistra definitely has a lot of exposure to that, and so it's been an interesting stock to sort of keep an eye on. So that's kind of the rationale for us getting a foothold. I think the negative on Vistra is, the valuation. It's not a cheap stock. It's trading over 30 times earnings. And it's been a bit of a momentum play this year, but with some of the pullback and rotation out of tech and AI this week, might be something for you to take a look at. Maybe there's a bit of an entry point there. Also like the fact that it's a very well capitalized, strong balance sheet. They're actually buying back a lot of their own stock. They've reduced their share counts significantly. They generate a lot of free cash flow. So again, I think there are certainly risks in the short term as a result of their valuation, and really just if you were to get a more extended pullback from AI-related names, undoubtedly it would impact Vistra in a negative way. So consider that if you are looking at Vistra. But I do think it's an interesting name to maybe take a look at. The Raymond James analyst here at our firm, he likes it for that combination of growth potential and balance sheet strength. One other name that we own in many of our client portfolios, and I own personally, that caught my eye this week is Amazon. Read a really interesting report from JP Morgan that highlighted their most significant grocery expansion in many, many years. And the reason it's significant is when you think of Amazon recently, at least if you've been reading all the research from Wall Street, almost none of it talks about their grocery business or even their delivery business. It's all about their AI capabilities and cloud storage. So it's almost their original core business has almost been forgotten. And what JP Morgan is noting is Amazon is really leaning into that expansion. According to them, they're going to add about 2,300 U.S. cities and towns to their fresh perishable grocery delivery network. And it's going to be free for Prime members. So JP Morgan's making the point that, listen, U.S. adjusted retail sales in aggregate is about roughly 43% attributable to consumer packaged goods and groceries, but only has about 15% online penetration. So they think that Amazon has a golden opportunity to expand that, which they believe will grow a greater share of consumer wallets, higher purchase frequencies, and support that Prime pricing because it justifies not only Amazon keeping Prime membership fees where they are, but maybe increasing those fees because they're offering a lot more for the money. And as a result, they think that the combination of low prices, leading assortment, faster delivery speeds really will be able to help them take potential market share from some of their big competitors. The key point for me is that I don't think this is going to be a big disturbance on the bottom line. This is expensive, right? They're going to spend over $4 billion to build out this network. But Amazon has done so much in the way of improving the operational efficiency of their distribution centers through automation, through robotics, through cleaning up all their delivery routes. They learned a lot during COVID when we were all sitting at home ordering packages every day. So it looks like from JP Morgan's perspective that they can do this and have it actually be accretive to the bottom line over time. So we'll see. We'll see how this all turns out. We'll be following it closely. But again, I wanted to bring it to your attention because it doesn't get a lot of airtime. Of course, the risks to Amazon are probably more on that AI spend side, whether they're getting the return on investment that they're expecting with all the investment that they're making in equipment and chips and what have you. And then, of course, the health of the U.S. consumer is always going to be a variable for Amazon, given that they rely on a lot of discretionary spending as well. So stay tuned. As I mentioned a few minutes ago, I'll bring you more on the individual stock front over the course of the next few weeks as we hear more from companies like NVIDIA, Broadcom, kind of wrap up second quarter earnings reporting season. As always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.